Private jet operator Flexjet going public today via a SPAC. The company merging with Todd Boehly's Horizon blank check company. Joining us right now, first on CNBC, is Flexjet's chairman, Kenn Ricci. He is also the principal of Directional Aviation Capital. Good morning to you.
Morning, Aaron.
Congratulations, I should say, I think, on this deal in an environment which, as you know, seems to be quite tough. Tell us why you ultimately decided to go down this path.
Well, first of all, there's been a tremendous demand in the increase in private travel. We're up almost 60% year over year. And so when you think about that, the market and where it's moving, we wanted to be sure that we had the capital to aggressively grow into this marketplace.
When you think, though, about going public via a SPAC versus an IPO, I don't know if you just thought the IPO window was closed, if there was additional opportunities to get capital in the private markets. I mean, speak to that, because a lot of people have looked at the SPAC market. Some of your competitors, Wheels Up, went public via SPAC. You've seen how the market's reacted to that. How do you think about it?
Well, I think it's not your father's SPAC market anymore. The days when pre-revenue companies were merging into SPACs to go public are so different. There's a lot of money in trust. There's a lot of SPACs that are looking for profitable, growing revenue companies, and we certainly fit that bill. And when you have competition among the SPACs, obviously, it then lowers your cost to market. And in many cases, the cost to go to market through a SPAC now was lower than if it was direct to market through an IPO. And when you take into effect that there's a $300 million backstop on the deal, then it also meant that it made it very compelling to do it in this manner.
Kenn, for those investors out there today who are looking at your company and are trying to think about the valuation and specifically about the comps, right? What is the comparable company to compare it to? I just mentioned Wheels Up. That came through via a SPAC. You could speak about some of the other companies that you think you compete with. I know at one point people were looking at Blade as another type of company, but you're a profitable company. Speak to how you think the investing community should think about comparables.
Well, first of all, we're so different from Wheels Up in that we're a subscription-based model, where Wheels Up is really an on-demand model. I liken us to a country club model. You pay a fee to join. There's a monthly fee to support the operation and a small fee when you actually take the plane. And so that model has proved resilient over time. 97% of our customers have retained us. We have a 97% retention rate. So we're really not Wheels Up. You mentioned the big one. We're a $2.2 billion revenue company with $288 million of adjusted EBITDA. Wheels Up is 1.5 with a negative EBITDA. They have a large, I think 47% of their fleet is turboprops. 60% of our fleet is super mids and large cabins. So we're much more into the international market. But the biggest thing about us is the recurring, predictable and forecastable revenue base. And we've done this we've been doing this for 25 years. So we've been through slowdowns in the industry. We know how the business is going to react when we go through, periods like we're going through now. And so when you ask who our comps are, it would be more of the subscription comps. It would be the Netflixes of the world. It would be those that have a consistent revenue stream with committed customers.
And Kenn, what are you seeing in terms of the business right now? We've heard from a lot of CEOs who say, look, our business right now is actually doing just fine, if not better than fine. What our concern is 6 to 9 months from now, that it may look different.
Well, never in our history have we had the backlog that we have now. I think there was a sea change in how people thought about private flying during COVID. And all of a sudden, it went from being maybe an extravagance to more of a necessity. And so we're seeing a whole different flyer that showed up, a flyer we've never seen before. Our average flyer is showing up 20 years earlier to start their first private jet travel. So that's actually like 20 more years that they'd be flying with us. So that's interesting. Our flying used to be like point to point and hard to get to places. Now it's really much longer flights, much more international, and that's changed significantly. So we've seen a change in the subscriber base. We have a backlog, and as I mentioned, you know, when you join the country club, just because things, maybe your golf game isn't as good, you still don't resign your membership. And having gone through the financial crisis, having gone through the dot-com crisis, we know what happens to our customer base, and there's a lot less attrition than you think.